Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, April 1st. Closing out Q1, I'm with the Moose, John Mousseau, President and CEO, and most important, Head of Fixed Income. John and I were just laughing that we're happy to see Q1 end.
Amen, brother.
Because not only were markets all over the place, we had a good dose of volatility right through the quarter. You know, when we look back on the equity side, you know, the numbers aren't shocking, right? S&P down about 5% in Q1. NASDAQ down about 10%. Some of the small and mid in between. Dow was the best performer of the major indices. But while any investor or trader understands that those type of numbers are par for being in the game, especially longer term,
right?
What was really out of line versus the past 5 years was the volatility.
Tremendous volatility.
There was extreme volatility throughout the quarter in equities. But there is some improvement going on under the hood. I like to say we look at the indices and where they're priced, but just as importantly, we look under the hood to see how trading is doing in terms of supply and demand, sector versus sector, industry versus industry, small versus mid versus large, right? So when we go back and look at that through Q1, value is obviously the top performer across the board in our equity strategies. You know, whether it was Berkshire Hathaway or RPV, which is the S&P 500 value index, that's where you were able to make some money. Growth, tough sledding. We've seen that come back a little bit, and that leads me to what I was mentioning about some of the analytics under the hood. If you remember back to January, Moose, I put out a trading alert.
I remember that.
The third week of January, because we had seen an extreme reading of new lows versus new highs. The reading was the most extreme it had been dating all the way back to 2008. And we've seen some nice improvement from there. When we look at new lows versus new highs today, over the last couple of days, even with some of the weakness, they've evened out. What that tells us is that extreme number we saw in January really flushed out an awful lot of sellers. Even if the indices didn't immediately respond and go higher. They started to 2-3 weeks later. Then in February, equities got hit again, but they traded what I call drier. The equity market wasn't as heavy, wasn't as wet. There were more things working.
Right.
So that's what we're looking at now. You know, before we jump over to bonds, it'll be interesting to see if value continues to have legs. Now, the last decade, call it 2010 through 2019, it was all about growth.
Right.
If you owned any value, you underperformed.
Absolutely.
It was a drag on performance. Diversification became a 4-letter word.
Right.
Right?
Absolutely.
The decade prior, when we look at 2000 through 2009, value performed very well. Small and mid performed very well versus large. International even performed okay versus domestic. My point being, it's important for us internally to stay flexible. We don't know what the next 1 year, 3 year, 5 year, 10 years is going to bring. And we have to let the markets talk to us.
Absolutely.
Not take our recency bias and spread that through our portfolio. We have to be as flexible as possible. And if we are, we're going to end up on the right side of the markets. So tell us about bonds, Moose. You've been ducking.
Nice to have the quarter over with. It was a rough quarter in bonds when you think about the 10-year bond started the year at 150 and closed the year at basically quarter at 240, and municipal bonds got hurt even worse because of the bond fund outflows. But we did have a little bit of stability this week, not nearly the dire moving around that we saw in the last few weeks. So that helped a little bit. You know, you had a jobs number today that was a little under the market expectations. Labor participation rate higher by 1/10 of a point. That's good because it means that suddenly more people are out looking for work. That should give a little relief on some of the wage inflation that's out there. So it seems like a little stability. We have one chart to show you how cheap, particularly the long maturity muni market is. On this chart, broken into two parts. You see the end of the year, you see a U.S. Treasury yield curve, you see a high-grade AA municipal yield curve, and you see the taxable equivalent. Basically, if you're in the 37% tax bracket, what's the value of that tax exemption? What do you have to earn in a taxable investment to give you the same? The biggest difference between the two periods is that in the longer end now, in the upper part of the charts, you see tax-free bonds cheaper than Treasuries, which means that when you gross it up for the tax exemption, it's a total giveaway. And there's many more bonds out there that are trading much cheaper than a AA GO. Bonds not at 4%, but mid to high threes. And we think that's tremendous value when you think about the fact that it's probably nearly a 6% taxable equivalent. And we think inflation will work its way down, and the markets would tell you that their long-term estimate of inflation is 2.5%. So take 6 minus 2.5%. That's a pretty good after-inflation yield.
That's a great net number. And,
yeah.
And John, in our Monday morning, going back to last Friday, we talked about the extreme outflows you were seeing in terms of the Muni funds being forced sellers.
Absolutely.
And Monday morning, in our portfolio management meeting, I brought up a momentum chart of MUB, M-U-B, which is a large ETF of municipal bonds, and it was at 150% oversold on a 10-week moving stochastic. Now, not to get into all of those numbers, but what it tells you is bonds had to be nibbled or bought there.
Right.
Had to. Equity-wise, we sometimes see sectors or individual issues get 140, 150, 160% oversold in very volatile markets. Rarely do we see bonds get there. As a matter of fact, when I see bonds, a bond market, whether it's taxable or muni or investment grade or junk, get any more than 100% oversold on a bell curve, it's normally a time to start nibbling. 150, you have to hold your nose and buy a little bit.
Absolutely, and I would add to that the fact that when you see these bond fund outflows, it always reminds us that at a certain level, separately managed accounts have the advantage of not being subservient to only that one price, the net asset value of a bond fund. So someone has a portfolio of bonds, not that the prices can't get beat up, we know that, but you don't have to sell. There's no forced selling in it. If you wanted to sell something, you'd have a choice of some lower maturity bonds that might not have been beaten up as much. So the flexibility of owning individual bonds really comes to the forefront in a quarter like this. Yeah,
no doubt. Those money managers, portfolio managers in the mutual fund space in bonds, they don't want to be sellers.
No.
They know they need to be buyers, but if their fund is getting outflow distribution notices, they have no choice but to become sellers.
And they don't sell what they would like to sell, which might be a bond that got downgraded or a credit that's going downhill a little bit. They sell what they can sell that raises money the fastest, and that's high-grade bonds, and that's what gets beat up, the best stuff.
Great info, Moose. Well, we'll see what next week brings. One thing we're fairly certain in an uncertain business is there'll be more volatility. And we've been fairly consistent with the fact that you can be patient in these markets. You're going to get your shot. We're going to get some shots to put some further cash to work. So everybody enjoy the weekend. We'll see you next week. Don't forget to like, comment, and subscribe. And clients and friends, we are having some maintenance on the website this weekend. Our portal will still be working, but if you have any trouble with the website, just give it a little time. We'll speak to you soon.